seen you speak so well and present to founders. How long have you been doing this?
I've been in the startup space for all my career, essentially. My first job was with GE Capital for about a year and a half, but I jumped into my first startup right after, which was an e-learning startup that I ran for about 8 years before it was acquired. I've then moved to the US, was looking to set up my own fund, realized that I needed to get a whole lot more connections, network, and learning before I could do that.
Why did you start Companion Ventures and why this name?
Companyon Ventures is exactly what it says, right? So our intention has been and will be to always work with founders, helping them scale their business. We're not guys who write a check, and then sit back hoping that things play out. We invest in companies and audacious founders that we truly believe in. We want to help them actively build their business. We roll up our sleeves, we help them with recruitment, we help them with putting systems and processes in place that will help them scale, and with advisory as and when it's appropriate to build those critical components of their go-to-market engine that's going to help them do everything a whole lot quicker and faster. So we're truly active partners. We're not just money in your cap table.
And in a typical year, how many investment would you make and what would be the check size?
So we invest in about 4 companies a year, and like I said, it's a lot of work that we do post-investment and also pre-investment, as a matter of fact. And we just we don't think we'll do more than that because it dilutes the focus and the support that we want to bring it. So it's always been 4 investments in a year on an average, and we take the lead position. We are leading the round. The rounds are typically between 3 and 10 million. Our checks are, like I said, we are the lead investors in those rounds. And we also continue supporting the business on follow-up rounds as well.
Okay, very nice, very nice. And I have been following you up on LinkedIn, and I read your Diligence Diaries. You talk about the product market fit being misunderstood. What is your take on the PMF?
So I think at a very, very simply put, product market fit is not a point in time event. Product market fit is a state of your company, as the state of the systems of your company. And that's the right lens to look at it. So, for example, if you have 1 customer or 2 customers who are buying your product and are using the product extensively, that's initial validation, but it's not true product market fit. Product market fit is when you have an engine that's running, that's building out leads, that's helping those leads convert into opportunities, and those opportunities convert into customers who are satisfied and consistently continue to use their product. And that whole cycle, when it works, that's product market fit, in my opinion. I think the key point that they should keep in mind is, founders should stop playing to an audience. Forget what investors think. Forget what everybody else thinks. You're talking about building a sustainable business. That sustainable business has to be running efficiently. And ideally, you want to take a step back at some point and let the business run by itself. That state that you want to achieve is product market fit.
Yeah. And Parthib, you lead Diligence all along the day and countless early stage software and AI companies. What are the first signs or early signs that you look in a founder or a pitch deck to really see that, yeah, this should go into the second phase and we should have a deeper look into it?
So the first thing that we're looking for, again, the whole point about us looking at a pitch deck is for us to understand the business by itself, right? And unless we are clear about what the business actually is about, we're not able to make an informed decision on what the subsequent steps have to be, right? So the first thing is we're looking for a clear, articulated story that tells us exactly what the business does. And that's just the baseline, that's table stakes, that's what we're looking for. The second clear thing is, now that if we understand what the business is clearly, then what we want to understand is whether this is a sustainable business and what the opportunity that lies ahead for the founder if he's running the business itself. And that's best represented in terms of metrics that we as investors, as a community, understand. For instance, we'd like to see what your growth rates are. Are they top quartile? Are they good? Are they bottom quartile? We'd like to understand what your efficiency in acquiring customers looks like. So, which is your sales magic number and your SaaS magic number, which talks about how you retain your customers, your revenue retention rates. So, again, just taking a step back, I think it's the ability for a business to, one, show with clarity what the whole business promise essentially is, and backing that up with evidence that this works, right? So that whichever by those metrics might be, it could be growth rate, it could be number of customers, it could be retention rates, but being able to support that assertion that this is a business that's growing and has high potential is what we're looking for. But to your question on whether that's what we're looking for at the baseline, but whether a business is ready for venture capital, and I think I should just talk a little bit about this, is I usually think about it, or at least my advice to founders is to think about it from two perspectives. One is your business ready for venture capital money, right? And that is based on a standard set of expectations, which is you need to have a market size that makes it interesting. You need to have those initial product market. I mean, depending upon which stage of investors you're going after, it's either if you go to angels, they're okay with having a prototype in place and some early evidence. If you go to raising a post-seed or when you come to a firm like us, we're looking for a lot more evidence of product market fit. But that's about your business's readiness to go to essentially take in venture capital money. The point that founders often forget to recognize or realize that, which involves significant effort, is being ready to take on venture capital money, which is ready to talk to investors, ready to deliver the information that the investors are looking for. And that by itself needs some preparation, a meaningful amount of preparation. Now, this is not different from, this is basically things that you would need to run your business. But being aware that it's not just the business being ready to take on new money, but it's also you being able to run that entire process is a critical decision point for founders as such.
Right, right. And Parthib, what is the time that you guys take to write those 4 checks a year? From the founder, when they reach out to you, how much time does it take? How much time do you spend in due diligence? And then, take us through the whole process. And what is your deal flow look like? How do you identify a startup to invest in, or how do they find you to, reach out to you?
So in terms of our overall process, we work with a number of other venture firms who refer deals to us. So that is one portion of where our deals come from. We also have a very strong sourcing engine. We've got some really smart folks who run our sourcing, really smart colleagues of mine who run the sourcing engine for us. So they're actively, reaching out to founders who have interesting startups. We always stay in touch with founders, someone we might have spoken to 6 months ago, someone we might have met at an event, but we keep track of all of that. We keep track of the advances that they've made, and we stay in touch. We try to be as helpful as possible through their growth journey, either through content that we put out, like my Diligence Diaries and the Investor Match series. We have tons of toolkits that's available on our website. We have great video content that we put out about how to manage your boardroom meetings, about how to identify key pieces of product market fit. We talk about what investors are looking for. So we essentially put out a lot of content that's accretive, that helps them build their business. And we keep in touch with them over time. And that's basically what builds our sourcing engine of startups that come to us. Our process is, because we've had a chance to be in touch with them, we have a fair sense of how well ahead or how far ahead they are in their process and whether they're ready for us. Our process typically starts with our sourcing team, which identifies opportunities and figures out whether we might be a good fit and whether they might be a good fit for us. And this is typically through one-on-one conversations. A partner gets pulled in when there is enough interest within the investment committee to say, okay, let's kind of dig deeper. And then we leverage our venture partner community. These are folks from industry. These are former CEOs or former operators who we kind of enlist to help us with our evaluation process. So we get them involved during the pitch meetings that we have with the early stage companies. And we assess different parts of the business. So we have specific deep dives into sales process, the marketing process, the product, the technology, finance. So we cannot try to cover every aspect, every functional area within the business. And all of this is aimed at us building that conviction that this is the team to back, this is the business to back, and we see a ton of potential that we can really get behind. So we're fairly fast. This whole process takes, I'm going to say, so a lot of this is dependent on the availability of data. Some companies are ready and prepared, so it's really quick. Could be 2 to 3 weeks that we kind of start from the initial call to making a decision. In some cases, it could be a month, or could be a little more than a month, depending upon, again, just the readiness of the team to kind of get ready. This is what I was alluding to when I was saying, hey, there's part A and part B. Part A is the business is ready. Part B is, are you ready to go take on venture capital?
Right.
But that's our process.
Yeah, great. You coined the term investor math. So let's talk about the fundraising strategy and the investor math. What does it mean, and how can founders use it and be prepared for the next raise?
So the investor math, the coinage of investment math came about because I often felt that founders somewhat think whether they do it consciously or subconsciously. I think they somewhat think that investor conversations are a little confrontational. The idea behind investor math was basically saying, hey, we've got a process that we follow as investors. We have a thinking process, we have a decision-making process that we follow. And the idea was to give them a look into that decision-making process so that they understand where we're coming from, where our questions are coming from, and provides that clarity with the aim that, hey, we're not trying to poke holes in a business. We're just trying to understand the business a whole lot better. So if you come in with the kind of, what would be the kind of information that you should be coming in with, which will help us go through the process a whole lot quicker. And that was the motivation behind the investor math series. In contrast, the Diligence Diaries were more operational. It was a large part of my role is also working with our portfolio companies, helping them navigate product market fit challenges and go to market fit challenges. So it's just some eureka moments that I've seen, that I've had, or insights that have been founder-led that I've learned from founders. And that's what that piece is about, to help them with the operational side of the business more than anything else.
So for the first-time founders, fundraising in itself is challenging for even 2x, 3x founders. There are various matrices that an angel group or a VC firm will look at. What are some of the important things that a founder must complete before they show up or even reach out to angels in the first place, and then after the angel to VCs like you?
Got it. When you're reaching out to angels, and I think this is very specific, very state specific. So if you're reaching out to angels, you probably have a couple of customers and you have some initial usage of the product. I think at that point in time, it's not so much about the revenue that anyone's investing in. They're investing in the vision. They're investing in the promise of the business more than anything else. So what they should be looking to provide is evidence that supports the assertion that their product is solving a problem for the customer. So it should be customer feedback, customer testimonials that should be available to them at that point in time. And I think it's important to have, in terms of pure metrics, is to track your product usage across time within your customers. Like whatever is the value that you're delivering, make sure you have some metric that's associated to that value that you're tracking on an ongoing basis, which is what you want to essentially showcase to any angel that you're talking to. Beyond that, as you come to our stage, which is Series A, what we're looking for is so we're a very data-driven organization. We are a very data-driven investor, and we want our companies to also be data-driven. We're looking for founders to essentially have a clear understanding of their numbers, and more importantly, they should have an understanding of what those numbers actually mean. right? So when you're coming to when a company comes to us, we're expecting them to at the very minimum understand what growth rates look like, what revenue growth rates are, understand the importance of gross margin, and tell us what their gross margin essentially is. We also want them to we want to understand, again, when you come to us, we're talking about having product market fit. Product market fit, if you ask me, is evidenced by how efficiently you acquire your customers, how well you're retaining your customers, and how much your customers are coming back and buying more. So for me, that's your sales magic number, which tells me how efficiently, or your CAC payback period. Both of those tell me how efficiently you're acquiring customers. In terms of how well you're retaining customers, that's your gross revenue retention. Essentially, are your customers who signed up on day one for $100, are they still staying with you after a year? And net revenue retention tells me how much more they are buying, how much more they're expanding on their initial purchase, right? So those are the core metrics that we think that we'd like our founders to know. Now, while I say that, we see a lot of founders who are technologists, and it's sometimes it is a new dimension, new aspect that they're learning, and they might not be as savvy as we would like them to be, right? So at that time, that's a part of the support that we provide, and these are the stages where we take a longer time through our whole diligence process to help them, enable them to be able to talk about those metrics as well, so that we understand what the business essentially is like, and we make an informed decision at the end. So it's not it definitely is not a disqualifier if you don't have all the key metrics that you should be talking about. We were looking for, but it definitely helps your fundraising process, the speed at which you fundraise, if you have all those metrics, and it also tells a more compelling story more than anything else if you have those metrics on hand.
Mm-hmm. What is a bridge round? At times, I see that somebody raised some decent amount of funds from angels, and now they are ready for a real VC with Series A. And suddenly, I hear that hey, we are raising a bridge round. How does a VC look at a bridge round, and what it really means to the investor who have already invested, and to the new set of investors who are going to commit capital to this startup?
So the bridge round by itself is not bad. It isn't. But it depends upon what's transpired before that's causing you to raise the bridge round. For instance, you could be raising a bridge round because you underestimated the amount of capital you thought you need in order to get to a Series A. Mm-hmm. So you probably raised 12 months of runway without realizing that the average time to a Series A is 18 months, at least. No, I'm not counting AI startups today, but before all of this happened, it was 18 months to 24 months to a Series A. So if you raise for 12 months and then suddenly you're running out of cash, you have early metrics and you need to kind of perform a little more before you're ready for that true Series A investor. Then you typically go on and raise a bridge round. In that context, it's totally justifiable. You could also have bridge rounds. I mean, in that context, the bridge round, we would think that your existing investors would be super interested in supporting you more because you are hitting those early metrics. It was a misestimation of how much time you need to actually go hit those Series A metrics, which is what is holding you back, which I think is not a bad thing. You probably see a markup in valuation in that round before you go in for your Series A. The other bridge round that you would raise is when your business is not doing well, when you're not getting the traction that you want. Maybe you have to go back and redesign your product. Maybe you have to go back and rethink who your customer really is, and you have to kind of start from scratch. That is usually tougher to go and raise for. That's the challenge. And those rounds typically would be a flat round. Maybe sometimes typically would be a flat round. You would not see a valuation increase on those rounds. So typically those are the two scenarios that play out that causes a company to go raise the bridge round.
Great. Let's talk about the post-investment and your involvement in the startups that you guys fund post-investment. What are the biggest operating blind spots that you see that majority of the startup founders that may falling into that pit kind of thing? Operating blind spots.
Got it. That's a great question. I don't think there are operating blind spots. I think typically it's more the founders or the founding team have a sense of where opportunity lies, but they just don't have the bandwidth to actually act on it, right?
Mhm.
As a founding team, as a startup, they are always resource constrained, and they just aren't able to put down the enough people or manpower behind specific initiatives that would be very impactful. So I think that's a part of our role, is to come and educate on certain dimensions that are really helpful for a business to understand, which will help them with growth. For instance, one of the key things that typically end up doing is while so one thing that I often talk about is that a company's customer base is never homogeneous, right? It's made up of distinct types of customers. Superficially, they might look to be the same, but there are distinct types of customers who have either bought for different reasons or using the product for different pain points they're trying to address. Now, if you think about it, ideally, when they say, do you have an ICP? And they say it's all companies with between 200 to $1 billion in revenue is my ICP. That is not really the ICP segment, because what it means to us, or what it means in reality, is that customer base can be broken down into subgroups, and within those subgroups, there's usually one segment which is going to give you an outsized return for your CAC investments that you make, your acquisition investment that you make. So that's the typical starting point of any kind of post-investment support, and that's a core component of your go-to-market, because you want to identify that ideal customer profile and double down, because you're going to see that customer group essentially grow quicker, grow faster, and typically easier to acquire as well. The work that we end up doing alongside our portfolio companies is helping them identify that group, figure out what is that messaging that's going to resonate with the group, and making sure that infrastructure can support selling into that group and scaling up from there. So that's one dimension that we help with. The second thing is just the whole instrumentation side. Again, because they don't have resources, right? So they don't have the level of sophistication that they should have in terms of, for example, in figuring out what their pipeline looks like, right? Their HubSpot infrastructure or whichever CRM that they're using might not be up to par. I think that's something that they typically don't have the energies to output or don't have the bandwidth to output into, and that's something that we work on more often than not. Again, our focus is very GTM centric. So we see these are key components that help you run a very efficient GTM engine, and that's why we come in to have a meaningful impact on our portfolio companies.
GTM and then pivot in business because of some market forces. If you have invested in some companies which was a true SaaS, and suddenly AI comes in, and now everybody has to pivot to some extent to incorporate the AI into their product market fit as well as in their product matrices. How do you help in revalidating or restarting the complete GTM? Because it could be very, very different now with the inroad of the AI tools which are now available to the potential customers also. So how do you help those type of companies?
So we haven't seen any of those within our portfolio,
Okay.
thankfully. But if we were to come across something like that, I think the way we would approach it is, I think it still boils down to going back to the basics and rethinking your entire GTM. Again, start off with your customer segmentation exercise, understand your customer needs very clearly, and reorient your product to basically ensure it hits all those elements that set you apart from your competitors and fulfills your customers' pain point. In some cases, from secondhand information, I can see that the approaches could be as simple as changing your pricing strategy. Don't sell on a SaaS, become a consumption-based model, so it becomes easier for your customer to justify the spend that they have on you. And I say it's easy. Pricing by itself is a big domain that you should think a lot about before you do that. But it could be as simple as a switch to a different pricing model might be the answer. But in some cases, it might be you will have to go back and redesign your entire product itself, right? But those are two possible extremes that you would essentially deal with. And I think it still goes back to fundamentals. You go back to the fundamentals. You have to go and rethink your value proposition. And I think the biggest metric that helps in the process, and again, even in product market fit assessment, is the time to value. The time to value. This is basically saying how long does your customer take once you've implemented your solution? How long is it before your customer realizes the first value event from your product, right? The shorter it is, the more effective your product is going to be. The shorter it is, the more happy your customer is going to be. So I think that's like, I would say that becomes your North Star that you want to keep completely focused on as you're considering all of these pivots.
Great insight. Parthiv, you have been in the boardrooms, you do term sheet negotiation. Take us through a process of a typical term sheet negotiation with a founder who is coming to a VC round. How does it look?
Um, so in my limited experience, the term sheet negotiations are typically around valuations, right? So there is a valuation, and there is a valuation expectation that a founder comes with. Now, that valuation expectation might align with what we are looking at, the way we assess the business, or might not align. And there are multiple factors that come into play when we kind of look at the valuation that's been set, right? For instance, we, as a venture firm, we're looking at a specific ownership target, and that specific ownership target needs to align with what our typical checks are, because we have a strategy of what our initial check should look like and what our follow-on check should look like, right? So being able to stay within realm and hitting our ownership targets becomes the critical factor, which is typically where we would go back, and if we at all get into a negotiation, we go back and push back on a valuation that might be proposed to us. Again, the point there is, while it's attractive for founders to raise at higher valuations, the more they have to keep in mind that for the final exit that they want to provide to their investors, the current valuation should make sense, and they should be able to draw a path and saying, okay, if I'm valuing my company at say 10 million in my seed, and I'm valuing it at 30 million in my series A, and I'm valuing it at 90 million in my series B, they should be able to draw the math to say, okay, what is it going to look like at exit? And that's the math that we're doing to say, okay, if I have 10% or I have 15% in this initial round, how much is that going to yield at the end of the whole journey, right? So that math, I think founders should take a look at, and that's what they should rationalize their valuations around. And again, I think that's one aspect of term sheet negotiations. The other aspect of term sheet negotiations, again, and this is something that we do, is we want to make sure that the founders are invested enough. They have enough equity holding in order to make the whole process interesting for them, right? This is not typically a negotiation, but this is something that we kind of insist. We'd want to see cap tables where they have enough representation and they have enough opportunity to have ownership, so that the exit for them is also meaningful, because that's what's going to keep them motivated. That's what's going to make it really attractive for them to stay in for the long run. So we're looking at alignment. So maybe just to summarize, I think I don't think it's negotiation. I think it's about achieving alignment, and that's the lens that you want to go in with for any of these conversations on the term sheet. Because we're partners, we're not confrontational, we're not adversaries, we are partners, we're trying to build a business together, and we want to support it as much as we can. Obviously, we want to see if the deal can make sense, and we're looking at it from the lens of saying, okay, how do we make this a win-win for you as well as for me, right?
The investor founder relationship, how does it start, and what a founder should do to keep the investors happy, other than meeting all the criteria and meeting their numbers? I have heard stories in the angel group, more or less, that we invested in a company, we have never heard from them for the last 9 months.
So that's again a very interesting point. I think it happens more often at the earlier stage companies, and I think it's a mark of the founder maturity more than anything else. I don't think founders don't want to keep investors updated. It's just that nobody's told them that, hey, you should keep your investors updated, because once you tell them, they usually keep their investors updated. So, but when they come to our stage, they're typically been through the process, so they know that they should keep their investors updated. But I think the point is that founders should look at investors as a valuable resource, just by the virtue of the number of companies that we see, right from pitch to what we invest in. We have developed a good sense of pattern recognition, which means we have a good idea of what's going to work and what's not going to work. So I think that's an invaluable asset that they should be trying to leverage as much as possible. So all our founders have weekly, not weekly, I'm going to say at least bi-monthly check-ins with someone from my team, from our team, one way or the other. And it could be either completely operational, it could be maybe advice on the board level, but there is a touch point that they have. And they leverage, they think of us as resources that they can use to grow their business, and they do that really well. And I think that's what every founder should look at doing. So your investors are your team, so use them as you would any other person on your team.
Mhm. Yeah, sure, sure. And if they do it, the future round of investment and recommendation and making the connection becomes much more easier. You did talk about the cap table and the founders should be invested in the company. What are those numbers? At Series A, do you think that if they still don't hold 30-35%, then obviously the commitment level will go away in future rounds, and then the founder is not the one who will be making some decent size money. What are those percentage that at least these founders should have when they are going to a Series A company?
I think Carta published this data recently, and I don't remember all the details off the top of my head, but I think it's about 45 to 60. So the idea is, I mean, I think there's 45, 65%, but the idea here is every round is going to lead to dilution. Right.
Right.
And I think you also have a sense of what the exit might be. The question that a founder needs to ask or needs to do the math on is to say, okay, after all the dilution that the founder's holding has by the time they get to an exit event, is the outcome going to be worth it based on their holding at that point? So that becomes that's the math. And I think it depends on what the initial structure is and how they set it up. But that's what we want to keep on top of. And the way we kind of address that in some cases, when we see that our founders are not there on the ownership levels, I think I've seen investors who assign maybe like an earnout based model, almost like performance based model, where there's more stock issued based on attaining certain milestones. That's one great way of doing it, or they give them an option to true up. So, but that's very important for us as investors, because we do want to keep them incentivized to go and execute against the business.
Right, right. Parthib, we are at the last segment. We are at the 33-minute clock. What advice do you want to give to early stage founders who are first time founders coming to VC? How they should prepare themselves? How about their data room? How about their cap table? Anything that comes to your mind before they approach you?
I think so. I'm just going to go out on a limb and say this. That this general advice that I've seen early stage founders do, which is like fake it till you make it, right? I get it. I think I understand why you would want to do that, but I think a better version of that advice is focus till you make it, because don't exaggerate the truth, but compound the truth. My bottom line here being, it's value is always greater than optics. You can dress up, make things look pretty, but at the end of the day, if it doesn't stand up to scrutiny, it's not going to get you anywhere. If not, if at all anything, it's going to erode the confidence and the impression that you've initially built up. So it's always better to back it up with actual evidence and actual value that you're delivering. So obsess on customer outcomes, obsess on how customers receive your product, and investors will see it, investors will follow. I think that's my advice.